Thanks for joining us today on Market Call. I'm Morella Fernandez. Brooke Thackray with us on the show. He's a research analyst at Global X, and he'll take your questions on seasonal investing and technical analysis. Call us toll free, 1-855-326-6266. You can also send an email, marketcall@bnnbloomberg.ca. Good to see you.
Good to see you too.
What's your take on the Cameco Brookfield U.S. government partnership just announced today?
There's more to come. I mean, this is just the start. If you take a look at what has to happen, and they need nuclear, like Canada does, and in order to kickstart it, this is exactly what they're doing. This is just a step of many of these type of setups.
Any concerns about the U.S. government partnering with Canadian companies?
No, not at all. I mean, there's a little bit of animosity sometimes between, at least on the Canada side, but I don't think so at all. I think as far as the national security issue goes for uranium, that's not a big deal at all. We share the technology anyhow. So I think it's a great idea. It'll be interesting to see if we can actually leverage off what they're doing down there. Because if we're getting serious about nuclear, providing power, the problem with nuclear is the only problem is it takes a long time to greenfield. It can be up to 15 years, especially in Canada, because the process is so slow.
And it's a lot of money that tends to overrun.
And exactly. But if you can start to actually build these units and standardize them, if they're starting to do this, we can piggyback and work with the U.S. as well. So I think ultimately this will also be good for Canada.
Okay, so Cameco, of course, up on the markets today. You say this is traditionally a weaker time for energy, which is actually surprising considering cooler months.
Yeah, so it's just the way the oil works. I mean, natural gas actually does well this time. So if you break down those two aspects, the energy sector itself, oil actually is a little bit weaker usually at this time, coming into the shoulder season, and then we move into a much stronger seasonal period for the energy season from February until May, ramping up for that driving season. Now, sometimes it can start earlier, so maybe it starts in December this year, but right now it tends to be a little bit weaker for the oil stocks.
Considering we're in such a power-hungry point right now with AI and infrastructure, could this be the off or the exception to the year, to the history, because of the demand for all kinds of power?
Yeah, so that really comes back to natural gas, because natural gas has to fill in the short term. There's no way around that. Nuclear could be there for the longer term out there, but how do you get there over the next 10 years? If you actually look at the projections on a go-forward basis for where the power is going to be coming from, it's natural gas. And we've seen that with Pembina and Meta signing up a deal just outside of Edmonton. We're going to see more of those setups as well. So yes, AI is a demand for that whole cycle, and we're coming into the colder season. And basically, investors want to front run that, so they tend to move into natural gas positions ahead of that colder season, which tends to drive the price of natural gas and natural gas stocks up.
Okay, we are going to take a quick break. We'll be back with Brooke Thackray, Global X, taking your questions today on seasonal investing and technical analysis. Back in a moment. Welcome back to Market Call. We're going to start with an email today from John. He says, hello, my name is John. I was wondering if your guest has an opinion on the ETF Life and why the healthcare sector seems to be lagging the market. Yeah, healthcare has been pretty beaten down. Do you think that was just because investors were so heavily after tech that everything else sort of took a back seat? And then if you can tell me about Life a little bit.
Sure, yeah. That's one of the reasons why healthcare has been beaten down. I mean, we've seen the same thing with other defensive sectors. The tech sector has just been sucking the oxygen out of the investing markets. Absolutely. The healthcare sector also as well, there's a lot of policy uncertainty with the new government coming in about what they were going to do for pricing for medications, et cetera. So investors stayed away from the industry overall. And there's some pipeline concerns as well as far as drugs actually reaching the end of patent over the next couple of years. There are a few drugs that are actually doing that as well. But we've reached a point where it's actually very attractive from a value perspective. And we're starting to see hedge funds actually getting into this sector itself. And we're starting to see a little bit of a bounce. So we could actually see the healthcare sector do well. Now, in this case, we're looking at the Evolve Global Health ETF. and it's an enhanced ETF. So it's in the it doesn't say it here, but it also has covered call options on top of the ETF itself. So it writes 1/3 of the covered call going out as well, which provides income in the portfolio. So it's in a defensive sector with a defensive approach as well. So that can be as part of the portfolio. There's nothing wrong with that. Usually, what you want to do in that case is with the covered calls, you want to see some volatility so that it provides enough of a premium for the manager to pass that back in. That might be a little bit difficult with the healthcare, but it can provide an extra benefit for that. As far as this ETF goes, if we look at this one here, we have seen sort of this trading range really that's taken place over the last couple of years. And this is not unlike what we've seen with the healthcare underperforming the S&P 500 anyhow. And we're seeing it come back up here. So this ETF is at, around coming up to 19.5, let's call it $20. And I would expect that to come back into its range. Healthcare can actually do well in the month of November as well. So I think this is actually poised quite well at this time.
Okay, I hope that helps out. John, let's move on to the phone lines. Michael on the line in Vancouver with his question today. Hi, Michael.
Hi there. I'm wondering about Amazon today. Has Jeff Bezos lost it? We'll look forward to the answer, but big tech took over and just what went wrong? They're laying off 1,400 employees. That's massive. So is it a good investment? Thank you.
Okay, so thank you for the question. Amazon, by the way, reports October 30th, a couple of days from now, and they announced 14,000 job cuts. The early reports had indicated it'd be twice that, and sometimes we know they do it in a staggered way. Is this AI sort of making it a little bit easier to let people go because they're taking all those backroom jobs?
Yeah, I expect more of this. I mean, it's not necessarily a sign that the company's not doing well. So they've been continually, announcing, yes, we're going to lay off people, we're going to lay off more people in the future, and they're expecting to lay off a lot more in the future down the road as well. So it's not a sign of a weakness. It's not like a manufacturing company itself, and you go, okay, that means they're making less. It just means they're becoming more efficient. There's some companies that are actually able to use AI efficiently at this point, and Amazon is one of the companies that is embedding it inside. So I don't think it's a big sign of weakness. We have seen Amazon sort of lag here a little bit overall, though, which is a little bit of a concern. We've seen the discretionary side of the market lag as well, and that's basically from weaker consumer demand that we're seeing, particularly in the bottom 4/5 of the income earners. We're seeing credit card delinquencies rise up. We're seeing the car repossessions go, but the economy's still strong.
I was going to say, how concerning is that to you?
I think it comes down to you have to actually say, well, I want to be in the parts of the market that are benefiting from that. And you have to be a little bit selective as far as that goes as well. But Amazon itself right now is just going through a little bit of a change. So you can see here that it's actually broken its upward trend, and it has just been moving out sideways from a technical perspective. At this point, I would expect it probably to show a little bit of underperformance. You really want to see a break above this level here, a little bit higher.
You call that 240?
A little bit, let's call it a little bit above 240 here, back here. And that would actually be, especially if we have rising volume, that would actually be a strong sign. But right now, I'd be waiting on this for the actual purchase as far as Amazon goes.
All right, let's get to our next phone call then. Mark's on the line from Ottawa. Hi, Mark.
Hi, can I get your thoughts on UnitedHealth? I know they reported today. Any thoughts on that as well as your technical analysis? Thanks.
Okay, thank you for the question. UnitedHealth has started to come back a bit. We talked about healthcare and that space being pushed down quite a bit. UnitedHealth suffered its own setbacks within the organization as well. Almost got double whammied.
Yeah.
What's your take on UnitedHealth? We'll pull up the chart, but it has started to climb back a little bit.
Yeah, it has started to climb back a bit. So it's they reported today. You see the strength there a little bit coming out, but this is actually pretty good because what we've seen a downward trend here. It's actually broken that downward trend and starting to move up higher. So in a sector, this company is very good value within its relative to its peers at this point. So from a fundamental basis, we've seen the technical starting to improve. We've seen a breakthrough at this point. So actually, I like this stock from this perspective. And as I said, healthcare can actually do quite well in November.
Okay, it's bouncing a little bit off of the latest earnings today. Okay, we're going to take a quick break. We're going to be back with Brooke Thackray, Global X, taking your questions on seasonal investing and technical analysis. Back in a moment. Welcome back. Thanks for joining us on Market Call. Let's go to Anne on the line in Scarborough, Ontario. Hi, Anne.
Hello, Brooke. May I please have your technical analysis of Nutrien, which I consider a seasonal stock? Thank you.
Thank you for the question. Haven't looked at Nutrien in a little while. We'll pull that up in a moment. When you take a look at a Nutrien, I guess there's seasonality involved in this stock.
Yeah.
Tell me about it.
There is. So you find the agricultural sector actually tends to do well this time of the year because of the cash flows that occurs within the agricultural sector, which tend to boost the stocks at this time. And it's all to do with the harvest as well in the Northern Hemisphere. So we haven't seen that Nutrien really benefit from that. Like I said before, technology sucking a lot of oxygen out of the markets. But if we take a look at it from a technical perspective, we can see here that it's broken its downward trend, and it is starting to form this base going out this way here. This is a positive sign. When it breaks its downward trend, starts to form a base, it's just looking for a catalyst to move higher here. And it's more likely to move higher than it is lower because it's broken its downward trend here. So I actually like the technical profile. It's not like a super strong stock where it's going to run away, but it has a decent technical profile.
And just out of curiosity, I was trying to figure out where it was at. Just above 75 is what you saw?
Yeah, so right now it's trading at $80. So it would be right here. I think it's actually pretty good at this level.
Okay, good to know. Let's get to our next caller. JP on the line from Edmonton today. Hi, JP.
Hey, thanks for taking my call. I had a question about Brookfield Renewable Partners. I know they shot up this morning. I'm not really sure what happened, can't find anything, but do you find it's a good entry point and interested in your technical analysis on it? Thank you.
Okay, so Brookfield shot up on the Cameco, Brookfield deal, since Brookfield is under the umbrella there with that big deal for the U.S. government. Do you want to take a look at renewables specifically and speak to it?
Yeah, sure. Renewables, we had that offset where they actually underperformed quite a while. People stayed away from that whole sector, but we're seeing a renewed interest in this, and we're seeing a renewed interest in the whole electricity generation. We're seeing this bounce up here. This is actually quite good from a technical profile. We've actually broken out above here. We've seen it try several times at, $38 or so, and we've broken much higher here, and we've actually gone past this point back here. So right now, from a technical profile, this is actually in a decent place. Usually you don't see stocks like Brookfield Renewables do extremely well at this time, but we've seen a little bit of a difference with the utility stocks and the renewables because of what AI is doing. They're actually making them a little bit higher beta play as well.
It's interesting because also we've seen Washington push back on renewable and green energy for sure. So that's kind of, you think, now in the backyard, and people are, again, interested in renewable?
I think so, yeah. So there's no question the U.S. has taken a different approach, but investors in Canada in particular see it a little bit differently as far as that goes. But there's still enough interest in this area that for it to do well.
Okay, let's get to an email. This email is from Jonas. He says, please ask your guest if Intel is a buy, sell, or a hold. Intel, of course, another firm that is doing business with the U.S. government for a stake in the company. Is Intel one you like?
Yeah, it's so hard. This company was lagging for so long. And all of a sudden, Trump comes along and says, hey, we're going to take a 10% stake. And they're benefiting. All these companies are investing in each other. This circular relationship. I looked at this map. I go, my goodness. And it's driving up all the stocks. So there's a little bit of an echo boost for that. The company's lagging in the key components of AI right now, and it's going to be difficult for them to get there from a fundamental perspective. From a technical perspective, I mean, it has had breakouts here that's going all the way across, and it is showing positive momentum at this level. It has had a strong breakout. So from that perspective, it's good. Technology tends to do well this time of year as well at the same time. So yes, from that perspective, I like it. Fundamentally, I'm not totally keen on it, but technically and seasonally at this time, it's quite well set up.
Out of curiosity, and you made a good point of companies sort of funding each other, an announcement in partnerships left, right, and center. OpenAI is one of them. Does it concern you about whether the money's actually there to invest?
Yeah, sometimes I think that maybe this is a symptom of there's so much money they don't know what to do with it at the time. We've got this money, but let's put it in here type of thing, and it's rolling back and forth where they're investing into each other. That's my concern. It's showing that there's but the capex is huge. I mean, they're looking at $400 billion capex over the last year for the Mag 7 alone, which is huge. But there's just so much money in there. So yeah, it does concern me a little bit with what's going on with that because it's not straight up third-party objective transactions taking place. So I don't know what's really happening behind the scenes.
Okay. Let's move to our next caller on the line is Bill in Peterborough. Hi, Bill.
Oh, hi there. Thank you for taking my call. My question is on Constellation Software. Since its high of 5,100 a few months ago, it's dropped about 20% on AI concerns and Mr. Leonard stepping away due to health concerns. It's trying to find a base here. It's been bouncing off 36.50, 30 a few times, but it just doesn't want to keep going. Can you give me your analysis on it? Thank you very much. Bye-bye.
Okay, thank you for that question. Constellation Software did get hit a couple of times.
Yeah.
And there are concerns about the model of its business, which is to acquire and sort of assimilate to a certain point and let the organization run as is. But with its model, will that be working moving forward? What do you think?
Let's just go back to AI for
Sure.
a second. If they have all these silo businesses, how do you leverage it all together? And that's where the real proving grounds is going to be a little bit tough for some of these companies. And companies like even Adobe, has suffered as well, because how do you actually use AI in a functional way with that? So we've seen the software actually get hit a little bit overall as far as that goes. From a technical perspective, we have seen that breakdown here. And we're not as finely tuned in as the caller was as far as the recent pricing. We can't show you what's happening as it bounces off here a little bit. It still isn't a downward trend. I would say that. We do have fairly good support coming in at this level here, though, at around 36, 3.6, around. In this case, we're here trading at 49, and I'm looking on the scale here. The scale seems to be off on the side, but. My apologies. Here we are at 37,
almost 38.
38,000. So right now, it's hard to see that bouncing back and forth there. But right now we are at a key level of support. So I would say that we can expect some sort of support. If it continues to break down below this, it will be in trouble though.
Okay. Let's get to an email before we have to take a break from Michael. He says, hi, Brooke. Great to see you on Market Call. Can you please let us know the seasonal strength for Canadian pipelines? Good question. We talked about the oil industry and seasonality for the end of the year. What about pipelines?
Yeah, so pipelines, because it's a totally different business than the exploration side. It's take or pay type of structure. The pipelines, the seasonality can actually start before the energy sector. So if you're looking for a good entry into the energy sector this time, this is not a bad time to be looking at the pipelines themselves coming up in November and December. So right now, before the energy sector gets in, I would be staying away from the major oil companies, but looking more for the pipelines at this point.
All right, we're going to take a quick break. When we come back, we'll have a look at Brooke's past picks. That's coming up next. Stay tuned. Time now for a look at past picks from Brooke, and these are December 5th, 2024 picks, so less than a year ago. At the time, he chose the technology select sector SPDR fund, XLK, out of New York. It was $239.91 US at the time, up to 326 right now. So 25% return, 26% total return. And this essentially mimics the technology sector. I was looking at the lines, very tight. What kind of companies are included in it?
So the ones we're used to, like Microsoft,
names.
yes, exactly, all the big names would be in there. So it's meant to really replicate the technology sector over time, and the sector's done extremely well. It's suffered a little bit in like back in August for a bit, but it managed to pull back up in September again. The technology sector is just basically sucking the air out of everything right now, and the real focus of that. I just want to say that the fund I work with, the Global X Horizons, Global X Seasonal Rotation ETF, we've actually owned the XLK and then sold it, and we now own it again as well. So because we're looking at it from a seasonal perspective. So this is a season when we find the technology sector will actually do quite well. And we have seen that happening at this point. There's a real focus on it.
Do you remember last year in December what made you recommend this one?
Well, we were seeing technical strength at a time when the sector was performing well. So if you have the two combinations where you see technical strength and strong seasonality, that's a favorable combination. If the fundamentals are there, that's also a good combination as well. And the sector right now is really, we can talk about the valuations, about the market and the sector, and it's very richly valued, but there still is momentum here. And it's going to be really interesting to see what happens on tomorrow, basically, after the market, because we see some of the big companies reporting. And we've seen some really good, strong earnings coming out so far. So we'll have to see what happens coming out there. If we're able to get past that day, I think we're going to see the technology sector continue to do well if we can get past that day without any surprises, which I'm not really expecting at this point.
Okay. Let's get to your next past pick from December last year. Global X Gold ETF, HUG on the TSX. Gold, of course, has done very well. 2048 when you recommended it last year, at 29.53 now, so 44% upside in return and total return. And this particular gold ETF, with the big run up it's had, it's probably come off a little bit of late, I imagine.
Yeah, absolutely, because it represents the price of gold. For full disclosure, I work for Global X, but we've seen gold actually doing extremely well in 2025. We saw this, just from a technical perspective, we saw this consolidation take place. And what gold's been moving in a pattern of consolidation, rally, and then we saw the strong rally in September into October, and we have seen a pullback. It's not really showing up so much here on this chart here, but we've seen a little bit of a pullback take place for gold. And that's going to happen. We've seen such strong strength for the gold. It became its most overbought in history, according to a monthly RSI. So we're going to see a pullback. Right now, we've just finished the strong seasonal period for gold. So the fund I work with, we actually sold.
When does that start, that strong?
That starts in July.
Okay.
So there's a period from December into March, and there's another period from July into early October. So we actually sold all our gold holdings over the last few weeks, but looking forward to getting back in again in December as well. So right now, from a technical perspective, where you would see a breakdown for this is if we actually, let's clear this off here. So here was this consolidation. If we went below this level, so if we went below $25, that would be a breakdown for, in this case, the ETF. And it would also be represented in the price of gold at the same time. But we haven't seen that pattern. We've seen gold go up, consolidate for a while, up and down, up, and then it go from there. We're probably going to look at the same thing. We're probably in a consolidation phase right now.
Okay, let's get quickly to your last past pick from last year. iShares Russell 2000 ETF, IWM, New York, 238.08 US at the time. Now to 248.98, so 5% upside, total return 7%. Are you still in this one?
No. So we had it for a month or two, basically, and then we exited. We'll look at it again coming up shortly as well. This graph here that we're looking at right now, from a technical perspective, it looks fine. You know, it's going up. We've gone past the high that we had back in December of last year, and everything looks fine. The problem is it's not going up as much as the market, which I can't show you here. And we are seeing some broadening out, but this is a higher riskier play because it has more exposure to regional banks, has more zombie companies. 30% of the companies in the Russell 2000 are zombie companies, which means that those companies have trouble just paying their interest from their earnings. So when we see interest rates go down, this company's going to do well. If we see risk on, it's going to do well. So right now, technically, it looks fine. We're not in the strong seasonal period, which starts in December again and into March. So it might be of interest later on. Right now, I wouldn't be looking at this.
All right, we're going to take a quick break. We'll be back with more of your phone calls and your emails in just a moment. Stay tuned. Welcome back. Let's go to an email from Terry. He says, please, can you have the analyst review Cargojet? Cargojet does transportation across the country, sort of freight, that kind of thing. Also in Bermuda and Poland is what I have here, which seems a little bit sort of one-off. But what do you think of this kind of transportation space? And, I mean, they wouldn't really be affected by tariffs very much because they're not flying across the border to the U.S.
Right. Yes, which is an excellent point. But if we take a look, trucking is down.
Mm-hmm.
The volume in trucking is down, and even within the U.S. as well. So we're seeing the transportation industry really under fire here a little bit. And in the discretionary, even like Amazon, as we talked about earlier, suffering a little bit. But if we take a look at Cargojet specifically, it has actually, back in 2023, here we were at $80. We went back down to this level here. So we did a round trip, back up again, and we're down to almost $80 again here. The concern is if it breaks below $80, which would be the concern at this point. If it breaks below $80, then that's actually going to be a bad sign for Cargojet. And more likely to head lower at this point.
And you think it's just getting dragged down by transportation being dragged down, nothing specific to Cargojet?
Yeah, I don't know that much about the details about the company. I know they made some changes, obviously, with what was happening with COVID, the shipping the materials and the underbellies of planes, and they've done some changes since then, since that space was now taken back. And they made some changes, but I can't speak specifically right now what's driving that.
Okay, let's get to our next email from Bert. What is your opinion, he asks, of Texas Instruments? Is it a sell or is it a buy? So they do semiconductor design as well, manufacturing. Is this a stock, when you look at the chart, that you would put some money into?
It's not. From a technical perspective, if you take a look, all these companies getting money and whatnot, just it depends where you are in this space with the semiconductors, basically. It is range bound. You would expect this company to have done better over time. We haven't seen that take place. Maybe the White House comes along and buys part of them out or something. Maybe. There's always a possibility. You don't know. Aside from that, this is not a company that, it's a lagging company at this point. So I would be more inclined to invest in another company in the space.
And if you own it, would you sell it?
Well, right now, the test really comes down here at 160. If it breaks below 160, then it would have some indications that it's going to head lower.
Okay. Let's go to another email then. We have Guy's email saying CNQ is a big oil gas holding of mine. However, currently CNQ does not have a large natural gas portfolio. Do you believe or strongly suggest that CNQ will eventually start eyeing some notable natural gas acquisitions in the near future? We were talking a bit about this at the break, about how much natural gas versus oil it has, and the fact that oil at this point in time, you said, usually comes off a bit. So in CNQ, what do you think?
Well, yeah, so CNQ's actually changed back and forth. There were a mix, and all the oil companies have done this over time. Sometimes they've been all oil, sometimes they move over to natural gas, and they come back a little bit. But yeah, so mainly oil. It's a great long-term hold as far as that goes. And I think, oil's been beaten down here. It's actually done okay here. I mean, from a technical perspective, we can see here that it's broken its downward trend line. It really suffered for quite a while. So this is actually a positive development here. So if you're a long-term holder, which the caller was, or the person who emailed in, I would be saying that this is probably, I would continue to hold. There's nothing breaking down at this point. It may lag a little bit over the next couple months. It's totally possible. But
and who can say whether it's going to pick up some more natural gas acquisitions?
Yeah, as far as that goes, I don't know I don't know what's going to happen from that perspective, and that would really have to do with their assets, what their objectives are, and I don't know.
Okay, let's get to the next email then from Tom. Does Brooke like nat gas? How does he feel about Peyto? Okay, so let's talk a little bit more about natural gas. When the season is for it to do well, natural gas has been depressed a little bit. And a lot of people have been putting money into natural gas, hoping that what we're building as far as infrastructure goes gets it to foreign markets. And that was sort of the play for investment. It hasn't really picked up yet.
Yes.
How do you feel about natural gas first as a sector?
So, yeah, okay, from a seasonal perspective, first of all, it actually tends to do well this time of year, coming into the colder months of the year. So before that actually takes place. Natural gas. The companies can actually do well ahead of that. And if you take a look at here, Peyto, this is a good chart, okay? This is solid. We're seeing this going as a solid upward trend developing here. And so I've got nothing negative to say about that chart. So, and we are seeing more of a demand for natural gas investment as well, because investors are realizing, nuclear is great, but we need to get there. And I mentioned that earlier on. And they're saying, well, and now we're seeing an express interest we saw the hyperscalers talk about, well, we want to buy nuclear power plants and down the road. And then all of a sudden everybody goes, well, that's down the road.
What are you going to do now?
And so we're seeing this interest take place. So I think that's going to continue to grow. And I do think Canada will do something as far as getting natural gas to Tidewater as well.
Okay. Let's move on then. We have another email from Mark. He says, looking for an ETF or investment broadly representing materials, gold, silver, copper, uranium. So we talked a little bit about a gold ETF earlier. That was a Global X one. Are there ETFs that have sort of copper, silver included, uranium maybe as well?
Yeah, this is really interesting. So back in the 1990s, there were a lot of mutual funds that actually did exactly that. They developed this diversified approach to the resource sector. And then before the tech bubble, nobody wanted that stuff. They said, we only want tech. And then, but then we saw some interest come back, in 2001 to 2007, because commodities did extremely well after the tech bubble broke. And so what we saw after what we're seeing now is we're seeing a renewed interest in commodities, but we haven't seen the ETFs come out for that. Now, the viewers in luck in the way that BMO actually just on Friday launched an ETF. Its ticker symbol is ZCOM, and it's a multi-asset ETF in the commodity space. Because there's increasing demand for this. Now, the one thing is the viewer asked about, they were looking for copper, some of the metals and precious metals. This one also includes agricultural as well. Wow. So what we call the soft commodities. So hard commodities and soft commodities. But across the board, there's renewed interest in this. So that would be, I don't know what the viewer's viewpoint is on the agricultural side or some of the soft commodities, but it's definitely one for the viewer to check out. Is the ticker symbol is ZCOM. It just launched on Friday.
Okay, so I'm sure there'll be some sort of press material out there, if nothing else. We're going to take a quick break. We'll be back with Brooke in a moment. He is taking your questions on seasonal investing and technical analysis. Stay tuned. Welcome back. Let's start with an email from Paul right now. He says, I noticed that the Denison Mine chart is very similar to Cameco. Do you see this continuing, or do you see Cameco breaking away from the pattern? Could I have your view on Denison's technical analysis? So Cameco breaking away today on that big announcement partnership with the U.S. and with Brookfield. But let's pull up Denison and tell me what you see pulling up Denison Mines.
Yeah, I mean, there's enough positivity for all of the mining companies in this space. So I wouldn't worry too much about if you have Denison versus Cameco and say, hey, Cameco's going to leave everybody behind. Denison will still do extremely well over time because we'll see similar announcements made. From a technical perspective, you can see here that we've had this breakout take place, and it's actually done very well since then. This is a positive breakout. There's nothing negative about this from a technical perspective when you see that breakout above the resistance level. So that's fantastic. The space Denison is in, here we are looking at a senior miner in this area. It's fantastic. I've got nothing negative to say about this space.
Okay, Denison Mines there. Let's go to Frank's email. It says, what are your thoughts on Celestica? Is it a buy? Let's have a look where Celestica is today, because I think it reported yesterday, if I'm not correct. And so they are up 6.8%. Just today on earnings report, so 28.84 gain. Look at that number, up almost 3,000% over the last 3 years. Can Celestica continue to deliver? When you look at a chart, what do you do with this?
Really, you can't.
Yeah.
There's nothing you can do because this is in arithmetic scale as well. So you've just got this going all the way like this. There's no resistance lines. This is what we call blue sky. Going up from a technical perspective, there's nothing I can really say because it's reaching all-time highs on a continual basis.
So interesting question then, would you pick it up where it is today?
So you'd be looking at other factors, and they've done extremely well with the whole AI data center build out, and they've been partaking in that side of things. I mean, it's interesting that this company was actually left for dead quite a few years ago, and it's just...
It did a turnaround.
Did a turnaround, and they've done extremely well with it. At some point, these companies are going to become very sensitive to negative news if it does happen. So yes, it can continue to do well. I probably would be more inclined myself to pick up an ETF representing the broader space at this point, because I think we're further along in that cycle.
All right, let's get to our next email then. David sent an email in. Your thoughts, he says, on Meg Energy, a 12-month price target, I guess is what he's looking at. Meg Energy, of course, in a deal with Cenovus. That looks like that's going to go through. It gets voted on soon. But there was a lot of back and forth with Strathcona and then Cenovus upping its offer. So I'm sure the chart has moved quite a bit during the last couple of months with all of that movement. Let's take a look at it and tell me what you think about Meg.
Yeah, so Meg, you're right. Meg has gone through all of this stuff with Strathcona and everything else. So that's sort of known now a little bit. And at this point, we're really trying to go back and look at the fundamentals and the technicals for Meg Energy at this point. And say, because we're past a lot of the drama. If we take a look at that, we're not back to the high we saw in 2024. I mean, obviously, Meg has benefited from this situation. But at this point, I would be holding back on buying Meg outright at this point because it's already baked into the cake what's going to take place as far as Cenovus. Obviously, there's always some risk as well. But at this point, we're not in a strong seasonal period for oil. I'd be waiting a little bit longer. I'm not speaking against Meg here, but I'd be waiting for a down tick. Maybe that's after the consolidation takes place.
All right, let's go to Alex's email. It says, may I have the guest thoughts on TFI International? TFI is transportation, yes? And they've been beaten down, which is something we alluded to. TFI, they've not really come back very well. There was a lot of sort of interest in it early on, and the idea that tariffs would hit them, but then they would bounce back.
Right.
Hasn't really happened.
Yeah, so it's not just TFI. It's all the trucking companies have really suffered here. There are too many drivers brought on board. The volume, and as far as the numbers go up for truckers, and the volume of actually shipments went down. So it was not a good situation, basically, for this industry. And we're not seeing anything really pick up to come back on that. So we are seeing a base case, which is positive overall for TFI here. But and so maybe it bases out on a longer term and starts to back up. And maybe we've had all that bad news already and it's pushed down here a little bit. I'd look for this to probably build out sideways at this point. On a seasonal basis, we do see the transportation and trucking industry start to pick up here a little bit. So,
really?
Yeah, we do.
In the cooler weather and in the winter?
It's also just the way that the shipments happen coming into Christmas time, and you get orders for commercial orders in the new year. It tends to be a busier economic time that takes place, and it also tends to more correlate to the economic cycle. So actually, from this perspective, I don't think there's a lot of downside for TFI at this point. So if you're looking to say, well, maybe it's basing here, I actually get into it, and maybe it starts to pick up soon.
Okay, but that being said, it could go sideways for a while.
It could, yeah, as long as you're being patient with it, yes.
All right, that is all the time we have for phone calls and emails and questions today. But Brooke will share his new top picks. That's coming up next. Join us tomorrow on Market Call. Mike Philbrick will be on the show. He is CEO of Resolve Asset Management. He'll be taking your questions on exchange-traded funds. And if you missed Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Time now for new top picks from Brooke. We will start with the Industrial Select Sector SPDR Fund, XLI, in New York. If you could just expand on what is included in the industrial select sector in this way.
Okay, sure. Yeah, so this would be some of the big industrial companies that we're used to. For instance, like Honeywell would be in there, GE, Boeing, those type of companies. So they're more in the manufacturing type of aspect. It has different subsectors as well. But mainly that's the best way to think about it. And so the reason why I've chosen this as the top pick today is we've actually seen it recently go out sideways, and we're seeing this really consolidation take place. And now we're just starting a strong seasonal period. As a backdrop, we're seeing the U.S. economy stronger than expected. We're seeing world economies actually doing okay, better than expected. There's no recession type of thing. And the U.S. is showing a little bit of a bounce back. So this is actually, I think, a fairly good sector to be in at this point. And we're in this consolidation. I'd love to see a consolidation before the start of a seasonal period. And here we are right at that particular time.
What is the seasonal period for industrials?
So basically, it'd be from October 28th, which is today, until May 5th. This is a small
Okay, so it's quite a long period.
like 6 months. It's a small period in January where it can lag a little bit, but overall it's about 6 months long.
And what feeds into that? Any reason for that?
It's more the economic strength of the economy that's really taking place. And this is when the economy tends to do well. If we look at from a non-seasonally adjusted basis and go through those numbers. So you find those types of companies with a higher beta actually does quite well at this time. So,
okay.
Yeah.
Let's get to your next new pick, which is called Snap-on, SNA in New York. They do tools and equipment manufacturing, vehicle repair, that kind of thing.
Yeah. So
What's your thinking along the lines of vehicle repair?
So, okay, it's a good aspect to take a look at. First, Snap-on, you've probably seen the trucks out there, which is the Snap-on trucks, and they provide the tools for the vehicle repairs at the workshops. They're 70% in the U.S., so they're really, which is kind of unusual for a large company. For vehicle repair, we're seeing more and more cars being held longer, further out.
Meaning people aren't buying new vehicles?
Yes.
They're holding on to
They're
what they have?
holding on to older vehicles, so the life cycle is getting stronger and stronger. And if the economy is picking up, this company would also be a beneficiary of that. Just like what I said about the XLI, this would also transfer to Snap-on at the same time. So it tends to have a strong seasonal period right now, starting now into the end of the year. And it's been fairly consistent in that time period. We've seen that over the last couple of years here. If we go to the graph here, we can see that with Snap-on here. We tend to find the end of the year tends to be quite strong for Snap-on. From this date to the end of the year, from 1990, it's outperformed the S&P 500 80% of the time. So that's really what we're taking a look at from a seasonal perspective, is we're trying to rotate into different places. In this case, we're not buying Snap-on. We're focusing on ETFs with the fund I work with, but this is a good example of a company that has a strong seasonality.
What's the competition like in that space?
They're the number one. I mean, there is competition. They also do not just tools. They do meters, for instance, that monitor diagnostics, and there are other companies that do compete in that space. But they tend to be number one in the space they're in.
Okay, let's get to your third pick, which is Global X Uranium Index ETF, HURA, on the TSX. And I was asking you earlier on whether you'd picked this before the Cameco announcement today, and you said you had. So why uranium at this point?
So first of all, it was time-stamped. I sent this in last night.
I was wondering when the email came in, exactly. I'll check with my producer.
Yeah. So I think this is a great way to play the uranium sector. Like Cameco, like if there's one stock to buy for the long term, and it's not big today, would be great. But if you're looking for a more diverse exposure to the uranium sector, I think this is a great way to do it. It has Denison Mines and it has Cameco. It's got both of those companies. It's also got the Sprott physical product, 15% in there. So it's a very diversified approach. And you can see that it's actually done extremely well here. And just like this looks very similar to the chart that we showed it with Denison. We saw two peaks here, and then we've seen this rally quite strongly here. We're in the strong seasonal period for uranium at this time. And look, uranium is actually a really interesting sector because we know everything about it. And when I say that, we know the demand long term, we know the supply long term, and yet it moves around with a lot of volatility. And I think that, and people get frustrated because they say, we know the picture, it should be going up all the time. That's not the way the stock market works. So we're going to see spurts exactly like what we're seeing today. And then we might see some pullbacks along the way, and maybe it comes back down 20%. But longer term, we know we're in a deficit for uranium to supply the reactors longer term. We know that. Everybody agrees. They may say the date's a little bit different at different times. Yes. So I think longer term, it's a fantastic sector to be in. There's no one piece of bad news for it.
But also, and you touched on this, but if you could expand, why go to the ETF side of it as opposed to the actual stock?
Well, because what we saw today was we saw a positive announcement for Cameco, and everybody goes, I wish I owned Cameco, right? of course. But sometimes you're going to get some negative announcements, maybe a mine having trouble as well. And that would be, the stock goes down, the other stocks go up, and you go, oh, maybe I'm glad I didn't have that stock today, right? So it works both ways. An ETF just gives you the broader approach to owning some of the junior companies, smaller companies like NextGen as well, that might have more upside than Cameco. So you're diversifying and putting into that mix overall.
So it's almost like if anybody announces a partnership or good news, you're going to benefit from it regardless.
Exactly. I mean, it's not like Cameco goes up a lot and nothing else happens in the industry. So there's the echo effect that's going to take place.
Okay, let's leave it there. We are out of time. Brooke, thanks for coming in.
Thank you very much.
And thank you for joining us today on Market Call. We'll see you back here again tomorrow.